Is the Fed falling behind? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Brent Donnelly, president of Spectra Markets. Hey, Brent, it's great to see you again.
Hello, Maggie. How you doing?
I'm doing okay. A couple of internet gremlins here, so hopefully the tech gods are with us. But uh, interesting action, and I'm glad to catch up with you. We've missed each other. You've been traveling, and you haven't been on a little bit, so I'm really interested to get your thoughts. We had a benign inflation reading today, but U.S. stocks weren't really able to hold on to those early gains. Does it feel like we're running out of steam here? I mean, we've come a long way off those April lows.
Yeah, it was an interesting day price action wise. I think if you're really into the micro price action, you could probably be a little bit concerned. We are getting right back up to the all-time highs and to all those resistance levels in the NASDAQ, which is like 22,100 to 22,400 were the highs in February. So I think people got a little bit nervous today seeing a China deal in theory, although it was just BS. I mean, it's just more of the same, and a weaker inflation number, which should be good for the Fed, and it's been good for the bond market. So the fact that stocks didn't rally today is a little tiny bit of an uh-oh, but I don't think it's a big deal. I think what it's more reflecting is that people are piling in at the highs thinking that we're going to break out, and then we didn't break out and everyone bailed. So I don't think it really means all that much more than what I just said, which is just like a lot of micro stuff, but macro wise, nothing has really changed. That looks bad.
Yeah, and I guess it's understandable that we're going to churn here, given how far we've come. Hey, everybody joining us live on YouTube and on Substack. Great to see you all. If you have a question, feel free to drop it in. We'll get to as many as we can. And as always, make sure you hit that subscribe button and like button. So, I think that you hit on one thing that I think is on the minds of people and causing a little hesitation, which is this feeling like we don't really know what the impact of tariffs are going to be, right? Like we had a benign inflation reading, but are we seeing it show up? Everyone's working off inventories. It was not clear whether what we're going to see in terms of prices. So I think after the headline hit, everyone kind of digested that. But we have the Fed really vocally pushing hard for the Fed to lower rates. This is not new. JD Vance out today. There continues to be that steady drumbeat. Do you think the Fed is behind the curve? Did the administration have a point, or what do you think the Fed's calculus is here?
So I do think they're behind the curve, but I think they've explained pretty clearly why they're intentionally staying behind the curve, and there's too much uncertainty around both growth and employment. Well, all three: growth, employment, and inflation. And so they're essentially saying we're going to wait until the last second, but then we'll probably go big when it's time. And if you look at what the rest of the central banks around the world have done, like a lot of central banks have cut to 300 basis points, like SMB and ECB, et cetera, Bank of Canada, et cetera. And usually they tend to be very autocorrelated and they all move at the same time. But the Fed's kind of holding out because they're worried that there's going to be an inflation problem. And I think that's generally what the market has been trying to play as well, is that these bad sentiment figures will then flow through to bad jobs, like hiring freezes and higher inflation and stagflation. And the challenge for the bears now is that you've essentially got like the workhorse data for May. You got payrolls, you got CPI, you got ISM, and the numbers aren't that bad. So the problem for the bears is that we're waiting for the badness and the economic policy uncertainty and the tariffs to flow through to the real data. And it's just not really happening yet. Like you see smatterings of it, like ADP, initial claims, continuing claims. They're all showing some weakness in the labor market. For sure, the labor market is soft, but they're not showing anything like horrible. And there is a middle ground where you get a continuation of the soft landing where the labor market weakens, say unemployment goes to 4.4 or something like that. And that allows the Fed to cut 2 or 3 more times. And that's bullish, right? So in the Goldilocks sort of soft landing stuff is still bullish. What the bears need is like really bad, like a negative non-farm payrolls and unemployment up 0.2 or 0.3 in 1 month. And you're simply not getting that yet. And then you have that against the backdrop of positive seasonality, and institutions are quite underweight. So retail bought the dip like super hardcore. and institutions did not. Like, in fact, a lot of institutions were short, and then now they covered, and CTA signals are going to start going off as if we make new all-time highs. So it's a very tough time for the bears, because now that CPI and payrolls are out of the way, it's like, what are you waiting for? Are you waiting for China or tariff headlines? I mean, the beta to these headlines is basically zero now. Like, the headlines came out, a couple of them were bullish, a couple of them were kind of bearish. The market doesn't even move on them anymore. It's just like if you ask hedge fund managers, like, what's the weighted average tariff rate for China right now? I think a lot of people wouldn't even know the answer to that. Like, it's become this situation where it's almost like, okay, we know there's going to be some tariffs and there's a lot of uncertainty, but let's see what the real world, what happens in the real world. Because I think people are kind of flashing back to, like, you go through every single year back to 2010, 2023, there was Silvergate. 2022 was like, Fed hikes are going to break the economy, or they're going to hike until something breaks and all that. And every year there's kind of like this issue, and the real economy, even if stocks go down and stocks go up, the real economy seems to keep skating through. And I mean, I've been skeptical of that, because I feel like the starting point now is that consumers don't have as much money. The job market isn't as strong, but yet we're still kind of like, yeah, there's some weakness, but there's not enough weakness to justify getting really bearish in equities. So then you get the positive drift and just kind of the default, which is stocks tend to go up when nothing's going on, and you got VIX down to onto a 16 handle, and then that forces the systematic guys to also start buying. So it's a tough time for the bears. I guess the last line in the sand is we're getting close to the all-time highs. So on a technical basis, you can kind of say, like, it's an okay place for bearish people to take a shot, since we're right back at the all-time highs. But even if we're entering like a period of really bad economic malaise from uncertainty and all that, I mean, the same thing happened in 07, and we knew subprime was a problem, and we still then went on to make new all-time highs before the crash in 08. So, I think it's always good to keep an open mind and to just think about the fact that stocks love to inflict pain, and being bearish is just a really hard position to be in unless you just have a steady cascade of bad news, and we just haven't. And I guess the final signpost really for tariffs is July 9th. That's the deadline. And there's supposed to be all these trade deals by then with Japan and Europe and all that. So I guess if you're bearish, that's one more thing you can kind of hold out hope for, is like EU talks break down or whatever. But even then, I think people are seeing like, okay, hiring's holding up. There's a lot of uncertainty. Maybe the bear case just isn't as strong as everyone, including me, thought it was, because normally when you get a massive spike in uncertainty and what looks like stagflationary policy, that's bad for stocks. But the reality is that the actual economic data still isn't reflecting it. So the irony, or the annoying thing for bears might be that the sentiment data all collapsed, the real economy held in, and now if stocks make all-time highs, the sentiment data will just catch up, because sentiment just follows price half the time.
Yeah. It's amazing. It's been this is the sort of recession that never, with so many, whacks at that piñata, and it's been a tough road. And I talk to people who have really great arguments, but this is, the problem is this is what keeps happening. Not a problem, but if that narrative,
it's a problem.
Let's be clear. Let's be clear,
Yeah.
it's not a problem. Let's throw a couple of other things in the soup when we're talking about potential catalysts. And I think you're right. It's so hard to sort of even think July 9th, because everything changes so much, even if it comes and goes and it looks like a disaster. You're only one tweet away from a walk back, right? So hard to pin it on that. What about the bond auction? So MK said 30-year auction Thursday should be interesting. What about that and the sort of debt side of things?
Yeah. So the interesting thing was, we had this really aggressive sell America trade after Liberation Day, where the market was selling stocks, bonds, and dollars all at the same time. And then stocks came back first, and bonds were still pretty nervous. When the big, beautiful bill passed the Senate, that was kind of the apex of like
the House,
or
right?
the House. I'm sorry. When it passed the House, that was kind of the apex of like the bond vigilante trade, where people were like, okay, these deficits are getting out of control. They're not serious about deficits, because when they came in, remember, when Bessent was appointed as Treasury Secretary, yields went down a lot because he had this 3-3-3 plan, which was 3% GDP, 3 million barrels, and 3% deficit to GDP. And if you look at where we are, I mean, that's a joke. Like, there's absolutely no improvement coming to the deficit. Doge was purely cosmetic. It has done absolutely nothing to deficits. And they're just increasing defense spending and cutting taxes in a way that's going to increase deficits even more. So people were kind of freaking out. 10-year yield went up to 460. But then it ended up being this kind of buy the rumor, sell the fact. And being bearish bonds is kind of like being bearish stocks, where you need a steady diet of news flow because it's expensive to sit there short bonds, right? Like, you're paying the carry, well, depending on how you structure it. So we peaked in yields right when it passed. And then now we're kind of, I mean, if you look at 10-year yields, it just looks like a random walk. Like, there's a real crosswind of there's people selling bonds because they're worried about deficits. So that's like a fiscal thing. Then there's people that were worried about like inflationary aspects of tariffs, but that hasn't happened. So really you're getting more of like a disinflationary vibe. And then you had Fed on hold. So for yields to really skyrocket, like, it's just a lot easier for yields to go up when the Fed's hiking. And now I actually think I was writing today, so that, like we said at the top of the show, that the Fed has kind of been waiting. At some point, like, Waller has been quite dovish. I think he wants to cut now.
I think
At
he
some
also
point,
wants the Fed chair job, doesn't he?
well, maybe, yeah. But at some point,
I
there's
don't
just
know.
gonna
I
be-
haven't spoken to him about it, but that's that. I've seen some rumors
I
about
have a
that.
selfie with Waller, but anyways,
Oh, that'll
so
be handy. You put it right behind you on that column if it happens.
but the thing is now is that, okay, so they think the neutral rate is down on a two handle somewhere and they're up at 4. So they can easily justify like 2 cuts, just adjustment, prudent adjustment kind of cuts. And I think I'm going to be watching the Fed speeches now really closely, because I kind of stopped following them for a while because it was just getting boring, because they were just on autopilot, on hold, waiting for the post-tariff data. But now, as they get a little bit of data, maybe like June CPI is okay, I think they might start turning quite dovish and indicate, okay, we're going to cut 2 or 3 times. Again, we're not going crazy. This isn't an emergency, but we need to get to neutral because they're in a very restrictive mode still. So you can easily argue that that Fed funds is too high relative to where growth and inflation and potentially unemployment are. So I think over the next, say, 6 months, you could get 2 cuts, but then in May 2026, you get a new head of the Fed. And essentially, I mean, that's going to be the most dovish person that Trump can find that remains credible. So whether that's Bessent or, I don't know, Warsh is a weird pick because he's historically known as a hawk. He was actually the one voice of reason against QE, against the last round of QE. So that's a weird one. But whoever gets picked is obviously going to be just doing whatever Trump says. So
Which is
then,
really interesting. You just made it. I just want to jump in. You made a
Yeah,
really
go ahead.
interesting point. Whoever's credible, that will be. I mean, this is farther out, but this will be an issue because he, unlike other positions, if he picks just anybody who's going to do his take his marching orders, and it's somebody who's not credible or is not seen to understand the global financial system, I would imagine that the markets won't take that very well.
No. So what would happen in that case is that people would anticipate that the Fed's going to cut, but that they shouldn't be cutting, and the back end will sell off. So mortgage rates will actually go up. Even if the Fed's cutting, the back end yields will go up. And so it'll end up being counterproductive. And I think they understand that. So he needs somebody who will cut, but can spin some kind of story that sounds credible so that the back end doesn't become unanchored, because ultimately it's always a confidence game. Like, even the US can push things very, very far as the reserve currency, but there is still a point where confidence expires and then you have a problem with the back end selling off. So that makes May 2026 very interesting, though, because then you'll be heading into midterms. And if you believe that Trump was trying to do this strategy of like do all the bad stuff first and then deliver all the good stuff later, in order to win the midterms, which is kind of makes sense, then bringing in someone super dovish in May 2026 is actually perfect timing. So it's really interesting from the point of view of like, if you play Fed policy, it's an interesting sort of kink in the curve because the standard orthodox framework may not apply after May 2026.
Yeah. It's also going to be tricky because somebody is pushing on the gas just when they're throwing all kinds of fiscal stuff at winning the election
Right.
presumably again. So
And I mean,
again,
that's,
to credibility and confidence, that's a tricky one for whoever dares to take that job.
yeah, and that's another big problem with the bear case in stocks is that, there's a somewhat mechanical relationship when they print money to create deficits. Some of that money ends up in financial markets, right? Like if
Mhm.
you pay out, an extra 20 billion to Social Security people, or to cut taxes, some of that money is going to end up in risky assets. And so if you thought deficit cutting was a real thing, which a lot of people did, it's a lot easier to envision like money being sucked out of the system. But if they're running 7% deficits with 2.5% growth and 3% inflation, it's just so hard for stocks to go down because you're debasing the denominator.
Yeah.
And that's just like that's manna from heaven for things like Bitcoin and
Yeah,
stocks.
and I just had a conversation about that this morning as well. Just want to throw in a comment, and because I want to talk to you about the dollar and currencies, because I think this is really important. Pathological doubt. Well, that says everything, doesn't it? I love that name. Just making a comment. It's so crazy. The economy in California is absolutely terrible. People getting laid off left and right. Entertainment, tech. These job reports are absolutely divorced from reality. I think a lot of people have been struggling as to whether a lot of the government data can just keep up in real time what's happening. I'm actually going to comment two things on that pathological. One is way back, Lizanne Saunders, when I spoke to her, had a really, I thought, interesting way of describing this as sort of a rolling recession. And you're absolutely right. Some industries are getting hit hard right now. But the problem is you'll see other industries which have scarcity in labor, especially when you look at, other sectors that have not been the hot sectors lately. So it's very hard for the whole picture. It seems like it's kind of been rolling, which is, I think, a hard thing for the Fed to grapple with. So
Well, and we saw the same thing in 2023 when Silvergate happened was people were tweeting from like the VC world, like these economic data points are bullshit because everyone that I know is getting fired. But like you said, it's very industry specific. So government and leisure and hospitality and all that are kind of pulling their weight or pulling much more than their weight, even as tech is struggling jobs wise. So I think it's very regional. It's very industry
mhm,
specific. And the aggregate, just because people are losing tech jobs in California doesn't mean that like hospitals aren't hiring in Vermont. So,
yeah,
but it does kind of feel like we're crossing a little bit of a turning point to me where it's going to be harder to find jobs. And the other thing too, to keep in mind is that there's still a lot of jobs that weren't filled in 21 and 22, or that weren't filled in the way that people wanted them to be. So if you look at JOLTS, like there's still more open positions than there are unemployed humans in the US. And that's unusual for that ratio to be above 1. So
yeah.
the market's absorbing the labor, like the labor force is absorbing people pretty well still in a lot of industries, but not tech. I'll acknowledge that tech, there hasn't been job growth in tech, that's
Tech
for
and
sure.
entertainment, by the way, could be the tip of the spear for AI, and so you just may be on the front end of that pathological doubt where you're living. So that's like an interesting trend to watch, and
Yeah.
can we adequately pick that up? I mean, these are real questions.
And I mean, economic data lags, right? Like we're seeing
Yeah,
stuff for May, which is like May 12th, over time. I mean, people were definitely saying like, hey, we're in a recession in '08 and the data was still okay. It was okay. And then it absolutely crapped out. So there is a little bit of a lag with the data
yeah,
as
which is
well.
why and I liked your description of the Fed trying to engineer this soft landing. The timing of this matters, right?
Mm.
They don't want to stimulate until you're into that downturn. Otherwise, they'll just, revive things in a way that's inflationary and not going to actually try to deliver the monetary policy they need. So it's a tough one. And
Well, and one
Fab
other
Model was right with us talking about AI. I saw your comment, and I think we said it at the same time. So I hope that answered your question.
Yeah, and one other point about the Fed is that it's kind of a weird situation where most people's mortgage rates are locked in. So they've had trouble really impacting, or the Fed funds hasn't really impacted the economy that much, even though mortgage rates have gone up a lot, most people are locked in at 2.9 or whatever. So as people finally, like people that did like whatever 5.7 or whatever the structures are of the mortgages in 2020, those things are going to start resetting. And then that's probably when you get like a super hard bite from higher rates. But the issue the Fed's been facing is that higher rates don't really do anything if everyone's locked in on the liability side.
Yeah, except maybe provide some income for, again, the high net worth who
Yeah.
know how to optimize that. So
Yeah.
I wanna jump to currencies because this is something, that has been coming up a lot, and a lot of strategists and a lot of guests that we've had on have been advising investors to increase their exposure to international markets because of what we're talking about. What do we need to understand about the currency risk involved in that? And you just talked about debasing the dollar. A lot of people think we're in the beginning of a long-term structural downturn for the US dollar, and you can tell me if you don't agree with that. But how do we need to think about currencies if we are thinking about being more international with our portfolio?
Well, I think unless you're a pension fund, generally, if you buy something like EWZ, which is the Brazil ETF, you're buying the Brazilian real and you're essentially taking the currency risk. And I think as a general rule, like that's what people want to do and that's what people should be doing. Like if you're investing abroad, you're probably also wanting to diversify away from the US. And if the US dollar is correlated to US economic performance and US policy, then you want to be diversified away from the dollar. And we're seeing a lot of that. Like it's interesting because like I said, you had the big sell America trade and then stocks came back and bonds came back, but the dollar hasn't really come back at all, like especially against emerging markets.
Mhm.
And I think people look at like really the Mag 7 stuff started in 2012, 2013. And so you've had 12 years of like massive outperformance of the US. And it's been a losing game, obviously, like since 2016. You can go back and find things from 2016 that say like, oh, too much tech concentration in the NASDAQ and stuff. I was reading something yesterday from 2016 saying like danger, red flag or whatever. And, things have tripled since then. But I think it does make a lot more sense now when you have extreme policy uncertainty in the US and a lot of policy things that could potentially scare away foreign investors permanently. The Section 899 thing, which is a bit boring to talk about, but it's like potentially a tax on foreign investments. And then also just simply the fact that some part of the US premium comes from US hegemony and US being like the dominant military and the dominant, leader of the free world and all that. And since the current administration does not want to do that anymore, then some of that premium should come out.
Mm.
Um, and then also, I think you just simply have like a valuation thing, right? Like if you're long the indexes, any global index, you're like 62% US, and really that's tech. So you're massively overweight tech if you're long a global index. So I think it's smart that people are diversifying. And the thing is like the return aspect has been really good, like DAX has outperformed and all that. But I think that's not necessarily the point. To me, the point is more that you're reducing your downside if tech
Mhm.
becomes, like if tech corrects, you're reducing your downside a lot by owning international equities. And then on the FX side, the real trade has just been to do the carry trades like short dollar Brazil, short dollar Mexico, because yields in those countries, like yields in Brazil, are 14%. So if you're short dollar Brazil and it doesn't move, you make a lot of money on the carry. And then the dream scenario in FX carry is that the currency appreciates that you're long, and that currency has a higher interest rate. So Brazil's been printing money. That trade has been printing money. And then in G10, it's kind of been the same story. Like we've seen a lot of pension funds hedging their dollar exposure, or even if they kept their equities, they just do the currency hedge. But overall, the only issue with the short dollars against, say, something like the euro is just that the US yields are still way higher than all those other countries. So it's kind of an expensive trade. Like if you want to be short dollars and long yen, you have to pay for the privilege, and then it gets annoying, and then people get bored of it and people cut. So that's why people have been doing short dollars against emerging markets. And also, surprisingly, like if you look at net international investment position, which is kind of like the balance sheet of the country or whatever, the US is super, super negative. It's not the balance sheet, but it's the flow of money. The US is super negative, but some emerging markets actually have pretty good NIIP, which then means like, okay, you're in a place where you're not worried about capital flight. Somewhere like South Africa or Brazil, less so Brazil, but you're in a place with high yields. Dollar depreciation helps you, and there isn't really that much capital flight risk. And in the US, we're always, for the next 3.5 years or whatever, there's always going to be a risk of capital flight because policy uncertainty is so high that if you can't trust that the rules will be enforced or that the rules won't change, then you start to get scared and you start to take your money out. I mean, that's what we saw in China for a long time, was they keep changing the rules and cracking down on billionaires and cracking down on tech. And essentially that's what the US is doing. They're saying, like, we don't necessarily want foreign investors to be in the US. So we don't want China stocks to be listed in the US or whatever. And so that policy shift makes it a little bit dangerous for foreign investors. And that's a good reason for US investors to then own foreign assets.
What an extraordinary time when the world's largest capitalist economy is at risk of capital flight. I mean, that's a one hell of a statement where we are. Just want to circle back. Normally I'd let that breathe, but I'm conscious of time and I want to circle back a minute for what you said. So not a lot, because we have a lot of really smart, really experienced people listening to this in this community. But let's say you're more of an individual retail person trying to figure out what to do. Mm-hmm. So if you are, say, okay, I have not diversified internationally, but I want to, if I buy a sort of an ETF that exposes me to Brazil, like a Brazil ETF, an India ETF, whatever, name your country, that if you do it through an ETF, that takes care of any currency exposure that you would have. You would not be, since you're a US dollar-based investor, be at risk of currency exposure.
No, that's not really true, because the ETFs themselves are so correlated to that currency. So like if you overlay the Brazilian real against EWZ, they're actually almost like the same trade. So you do get currency risk. There are ETFs that hedge the currency risk. Like there's a yen one where you can be long Nikkei, but you're not long yen. But those are specifically hedged FX ETFs. So if you don't buy a hedged ETF, which most people don't, then you're giving yourself, you're implicitly taking currency risk, even if you don't actually you're doing it in the US. So there's no actual currency risk because you're buying a US dollar-based ETF. But that ETF that you bought is going to be super correlated to what that currency
Super correlated to the currency, right?
Yeah.
Okay, let me give you another example that's come up. So say somebody likes a Canadian energy company. It's listed in Toronto, New York, and Australia. As a US dollar-based investor, do we need to consider that or worry about that? Or it's just like, you're in the US, you're investing with dollars, you're going to invest in, as you just said, a US-based ETF. As long as you have exposure to that, you get the upside of that company if it does well, and not have to worry? Or do we need to think about differently if they're listed in different places to try to maximize return?
It's marginal. So like if you look at, say you buy like a Canadian energy company and then look at what happened 5 years later, the currency as element of that is going to be tiny relative to the alpha from the actual change in the business prospects of the thing. So I would generally say I would do the thing that's easiest. Like, don't open up Canadian dollar accounts just so you can buy 2 Canadian oil companies. It's just not worth it. Like, yeah, the return profile will be slightly different because you're operating in 2 different ways, but the currency aspect in G10, like currency vol in G10 countries isn't high enough to really be like a massive input into your foreign investment returns.
Yeah, that's great.
So
We
just
get
to
these kinds of
simplify,
questions a lot, like
yeah.
how does it make a difference if I do this? Because let's face it, everybody was, overexposed and had a lot of tech and a lot of US stocks in, and now there's kind of a generation of folks who may not have touched international stocks in a long time. So,
Yeah,
um,
it's funny. That used to be like a very common knowledge thing, was you diversify internationally, and then it just didn't work forever, right?
right.
Because most foreign stock markets are like deep value commodities and like boring manufacturing and stuff like that. And the US is growth and innovation. And that's been the case for so long that people kind of forgot about international markets. But now maybe that's a reason to go the other way. I mean, I will say, like, that theme has been very popular in 2025, but these regime shifts last years, like we had a regime of sell dollars and buy foreign assets from 2001 to 2007. Basically, it was a 6-year trend. So just because it's popular after 3 months doesn't mean that it won't be popular for another 3 years.
That's a great comment, because of course we all are conditioned to think, did we miss it? Are we buying at
Mm.
the top? Did we miss the boat on that if we haven't done it already? Melson commenting, capital flight from the US to where? The American exceptionalism is over, trade is getting wrecked.
Yeah, that is true. It's yeah, that's a funny one. It's the reverse of the reverse. Um, I mean, that's a very good question. In terms of, it depends if you're talking about currencies or equities. And in terms of equities, I guess the money is going to like defense contractors in Germany, like Rheinmetall, and places that are going to benefit from higher deficit spending and higher defense spending in other countries. And then there's like a whole cohort of people that believe in the commodities trade. I don't really believe in it. I don't know. I feel like it's a dud more often than it works. But the other answer to the question is, a lot of people are putting money into commodities because they feel like devaluation of the dollar and sort of a rebound in China one day will eventually lead to better days ahead for commodities.
That's a longer term hard asset play.
Yeah.
What do you like? Let's finish up with, what do you like the best here, Brent? Is there anything that you feel is a good opportunity?
Well, I'm actually more with right now. See, like, I'm kind of short term, as you know. So the last like 2 weeks, I've been more with the whoever, I didn't see the name, but the person that just asked the question, and just going with the rebirth of the AI trade, because really, like, we had a really severe test of it after DeepSeek, and now like Nvidia looks like it's almost ready to make fresh all-time highs. And the biggest problem with a lot of the stuff was valuation. Like Palantir, for example, is still like the most overvalued mega cap in the history of the stock market. But Nvidia has kind of, like, it's been in a range for a year, and it's kind of grown into its valuation. Like, its price to sales went from 45 to 22 or something in the time, because the price of the stock hasn't moved, but their revenue is still going up. So I'm playing that kind of stuff. But like I said, I'm pretty tactical. Like, I started about 2 weeks ago, and I could be done in 2 weeks from now. So
Yeah, yes, that's always important to talk about time frame. So I appreciate you putting that in there. That last one is very specific. Stephen asking, please ask Brent if the macro trading floor will return soon.
we recorded an episode this morning, so it'll be on Spotify tomorrow.
Fantastic. There you go. Brent, always great to catch up with you. I know you told me you're off to Brazil, so that's going to be super interesting. Would love to catch up with you when you're back from that, and get your sense of what's happening on the ground there. So I know a lot of people, when they're thinking about diversifying, are certainly looking at that region with a lot of interest.
Yeah, it's random timing, but yeah, it's great timing because Brazil's kind of hot right now.
Fantastic. Good stuff. Thanks, everybody. Great questions. Thank you so much, Brent. It was lovely to see you again, and we'll catch up again soon. Safe travels.
All right. Thanks. Thanks,
Take care.
everybody.
Good luck out there, everybody.
See ya.